Hey everyone, and welcome back to the channel where we demystify the markets and shine a spotlight on unique trading opportunities. Today, we're diving deep into the world of hard-to-borrow stocks, specifically focusing on a microcap in the healthcare sector, VRAX Biolabs Group Limited, trading under the ticker VRAX. This stock has recently hit our screeners due to some truly eye-watering cost-to-borrow numbers. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what exactly is VRAX? VRAX Biolabs Group Limited is a biotechnology company with a tiny market cap of just $2.05 million. They're focused on immune response detection, T-cell immune profiling, and developing in vitro diagnostic technologies for viral and immune-mediated diseases. Their operations span the United Kingdom, the United States, and China, and they offer a product called VRAX Immune. Show VRAX logo and brief description on screen. This is a true microcap with an estimated float of only 0.8 million shares. Looking at recent price action, VRAX has been under significant pressure. Today, the stock is down 12.36%. Over the last 5 days, it's fallen 15.83%, and in the past 30 days, it's down a steep 27.91%. Volume has also been notably low, with today's volume at 182,400 shares, which is only about 0.1 times its 30-day average volume of 3,082,908 shares. What is cost to borrow and why it matters? Now let's talk about why we're even looking at VRAX. It all comes down to something called the cost to borrow fee, or CTB. Show cost to borrow text. When you want to short sell a stock, you first have to borrow shares from a broker. The cost to borrow is essentially the annualized interest rate you pay for borrowing those shares. Think of it like a rental fee. When a stock is hard to borrow, it means there's high demand from short sellers and a very limited supply of shares available to lend out. This scarcity drives up the CTB fee dramatically. These fees can easily exceed 100% and sometimes even hundreds of percentage points because they reflect the intense supply and demand dynamics in the borrow market. A high CTB is a flashing yellow light for potential volatility, as it indicates significant short interest combined with difficulty in maintaining those short positions cheaply. Why this stock is hard to borrow right now? So, for VRAX, the current annualized cost to borrow fee is an astounding 680.2%. Highlight 680.2%. This is an extremely high number, signaling that short sellers are paying a premium to bet against VRAX Biolabs. While the exact number of shares currently available to borrow is unknown, this sky-high fee, coupled with VRAX's tiny estimated float of just 0.8 million shares, strongly suggests that borrowable shares are incredibly scarce. Our internal composite squeeze score, which combines factors like CTB level, borrower supply, float size, and momentum, sits at 41.7 for VRAX. This score suggests it's a situation worth monitoring, not necessarily an imminent squeeze, but certainly indicating significant pressure in the borrow market. Remember, a high CTB doesn't guarantee a squeeze. It can also indicate short sellers have strong conviction and are willing to pay these high fees to maintain their bearish bets. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when the price of a shorted stock rapidly increases, forcing short sellers to buy back shares to close their positions. Here's how it works. Short sellers profit when a stock's price goes down. If the price starts rising instead, they face increasing losses. To limit these losses or meet margin calls, they have to cover their shorts by buying shares back on the open market. In a stock like VRAX with a very small float of 0.8 million shares, if enough short sellers are forced to cover simultaneously, the demand for shares can far outstrip the available supply. This sudden surge in buying pressure, often fueled by panic covering, can send the stock price parabolic in a very short amount of time, creating what we call a short squeeze. Dilution risk check. One critical factor to consider with any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the per share value. Even with a high cost to borrow, if a company is actively diluting, it can completely negate a short squeeze thesis. We're happy to report that for VRAX Biolabs, we found no recent dilutive SEC filings like SMINUS-1, SMINUS-3, or 424B in the last 90 days. This means there haven't been recent primary offerings that would suddenly flood the market with new shares and provide easy cover for short sellers. This is a positive sign for any short squeeze thesis on VRAX, as it indicates a reduced immediate risk of new shares being issued. Recent reverse split watch. Something else crucial to understand about VRAX is its recent corporate action. VRAX Biolabs executed a 1-for-25 reverse stock split on June 26, which was just 27 days ago. A reverse split reduces the total number of outstanding shares and, in turn, increases the share price proportionally. For VRAX, this significantly reduced its float and reset the share price higher. It's a common move for microcap stocks that have fallen to very low price levels, often below minimum exchange requirements. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure and price. However, this is a pattern observed in some microcap names, not a guarantee for VRAX. While it can introduce renewed speculative interest or technical trading, it's essential to remember it doesn't fundamentally change the company's underlying business. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So if you're watching VRAX, what should you keep an eye on? First, continue to monitor that cost to borrow fee. Any sustained increase or even maintenance at these extreme levels is key. Second, look for decreasing shares available to borrow, which would signal tightening supply. Third, watch for a significant spike in daily volume well above its current 30-day average. A short squeeze needs fuel, and that fuel is often buying volume. Fourth, look for price momentum to reverse the recent downward trend. Finally, any specific news from VRAX Biolabs itself, perhaps clinical trial updates, regulatory approvals, or new partnerships, could act as a catalyst. Given the recent reverse split, monitoring how the stock behaves in the coming days as it moves further into that 1-month post-split window could also be insightful, keeping in mind the historical tendencies we discussed. In summary, VRAX Biolabs Group Limited, or VRAX, is an intriguing case study in the hard-to-borrow space. Its 680.2% cost to borrow, combined with an ultra-low float of 0.8 million shares and the recent reverse stock split, puts it squarely on the radar for potential volatility. While there's no immediate dilution risk from recent filings, remember that high CTB is not a guarantee of a short squeeze. Always conduct your own thorough due diligence. If you found this breakdown of VRAX helpful, please hit that like button, subscribe for more unique stock insights, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you. Thanks for tuning in, and we'll see you in the next video.